Well, the last couple of months have been pretty big in the money world. We've had home buyer changes, investment market mood swings, changes to workplace protections, and like a whole bunch of stuff is going on at a time when I don't know how you're feeling, but like I'm just ready to slide on in to the end of the year. But no, the world, annoyingly, continues to turn and pivot and change. And so I thought today I would give you my hot take on what in the world is going on, in case you, like me, have been trying to bury your head in the sand just trying to make it to the end of 2025. Okay, so today's episode is a little bit different. I'm going to do a bit of a around the world, what is going on that I think you need to care about. Why do you need to care about it? What is my hot take? And what do you do from here? We are going to go not necessarily around the world, if I'm honest. We're probably going to stay in Australia, but there are some global things that are happening that I think you should also be aware of. Let's bring you up to speed in what in the world is going on in the money world and what you should do about it.
This is a podcast for everyone that wants to learn how to make fierce and bold choices with their money. We'll talk about how to shape your money mindset, investing for your future, your spending habits, the good and the bad, plus how to achieve your financial goals, and most of all, how to be financially fierce. I am a financial educator and I want to empower you to be more in control of your money and build the financial future that you want. I run the Greenhouse Money Growing Program, and you can find details of that in the podcast show notes. My name is Jessica Brady. It's time to get financially fierce.
Okay, I just would like to say that I've been on leave for 1 week. Weirdly, this is my first week. Today's my first day back. After my first week off, that was non-hospital related of 2025, because I feel like taking leave to go to hospital or recovering from hospital or surgery or needing to go back into hospital, despite not working, that to me is not classed as a fun time. But I've just had a week off, and I feel like the week that I've had off, a lot has changed. And so I come back today with a whole bunch of things that have happened over the last little while. And I'm like, wow, I need to get up to speed. And thus I will bring you up to speed as I get along, or up to date with what is going on as well. So I want to start with the big ones, because at the time of recording this, last Friday, which was the 5th of December, we had some changes or some updates to the Help to Buy scheme. And when I say updates, what I actually think I mean is it launched. So this is the shared equity scheme that the government has been talking about for a little while now. And I wanted to give you a little bit more information because, my friends, it's gone live. Again, who is just like, yeah, we'll just start this in December. We'll just quietly get it going. There's a fair bit to get your head around. This is different to the 5% deposit scheme. I'm going to talk a little bit about what you need to know on that front in a moment. But given this is so new and just kind of, should we say, hot off the press, I wanted to give you the deets in case this was of interest to you. Let's just step back a bit. The Australian housing market is diabolical. If you answer diabolical, I would say that is correct. Gold stars for you. It's not funny, but like, what can we do? I think we just must laugh in these times. However, what the government have put in is a whole raft and range of different things to try to make purchasing a property more accessible. My big fundamental thing here that I bang on about all the time is it is not making it more affordable. Make no mistake about it. It is more accessible. However, with a little asterisk, this might be the one that has the biggest sniff, if you will, of affordability in it. The others, I just think, is like, yeah, we'll get you in, we'll pile you up with debt, and you can just have a great time from here on in because you are a homeowner, my friend, you've made it. This one, I think, actually does look at how can we make it so that you are not at risk of, I don't know, defaulting or being able to only afford tuna and rice for the remainder of your days. So like, I'm more on board with this as a concept, I think. However, I've got some issues. Obviously, it's me. I've got issues, but I need to give credit where credit's due. All right, so the government has launched last Friday, the 5th of December, at time of recording, the Help to Buy scheme. What the hell is the Help to Buy scheme? According to the firsthomebuyers.gov.au website, it is a new initiative designed to support more Australians to buy a home. Cool. How on earth does this actually work? Let's get into the weeds, yeah? First up, I need to say that it looks like there's only 10,000 placements available each year. So this is not available to absolutely everybody that wants to participate, and you'll see some other eligibility criteria in a moment. We're capping this. When I say we, obviously I don't mean we, I mean them, have capped this at 10,000 places per year, which is interesting because if you look at the 5% deposit scheme, they actually just took out the caps. But obviously, probably because the government's got to cough up some more cash, they want to be a bit more restrictive about this one. So you need a minimum of a 2% deposit. I have some worries about that. But anyway, that is the eligibility criteria, minimum 2% deposit. The government, you're basically going into a purchase arrangement and the government's going to cough up some cash with you. So they're going to own a bit. I'll explain how it all works. And you're going to own a bit. And frankly, the bank owns the most while you're in debt for it. How much does the government contribute? It depends. So it's up to 30% for existing homes or up to 40% for newly built homes. I presume that is trying to incentivize you to buy a newly built home because that would create jobs and stimulate the economy. That's my guess. I think you should definitely go and do your research about, newly built homes and whether that's the right thing for you to do. But it is interesting that there's a differential, 30% if you buy an existing home, 40% if you buy a new home, in terms of how much the government will contribute. And as I said, there's 10,000 places every year. So basically, this is trying to address this fundamental issue, I think, of how unaffordable housing is and how much banks will lend to you. Because if we have average property prices at, I don't know, what is it now? 800, 900,000. But your income means that the bank will only lend you, let's say, 600,000. I mean, either you're not buying a property or you're borrowing 600,000 and buying what you can afford for that budget, or hoping that, I don't know, the bank of mum and dad or, I don't know, the tooth fairy will deliver a huge amount of money, which is not always possible. But if the government can take on a certain percentage, then actually maybe you can get that $800,000 or $900,000 property. There are some caveats, and I'll go through that in a moment, and still borrow that $600,000. So you're not getting into as much debt potentially as you would have needed to. Not potentially, as you would have needed to if you were buying the same place. But the issue is that the banks probably wouldn't have lent it. So, I think we need to be honest about the fact that this is because house prices are wild in terms of multipliers of income as a ratio. So the house price to income ratio is terrible. And so, I think that this is good news in that it's going to help people be able to buy a property that has probably more longevity. So something that, you can't necessarily afford on your own. You don't necessarily have the capacity or ability to, I don't know, bankroll for the full amount or get mum and dad or whoever to help you. But what we often see is more sort of stepping stone properties. So, you buy your first property, it might be the tiniest shitbox there ever was, but it's yours. And so you're bloody happy with it. But then you might quickly find that you've outgrown that. And then you've got to sell that has transaction costs. You've got to buy again that has stamp duty implications. Whereas perhaps being able to do this means that you've got a bit more of a runway or you can, live in that property, I don't know, longer or indefinitely. There's a bit of an issue that I want to talk about, which I think has been missed in the small amounts of stuff that I've seen on this so far. But this is the big caveat, I think, and I think this is where it is needing some changes. It says you must have an annual taxable income at or below $100,000 for individual applicants or $160,000 for single parents and joint applicants. This is based on your notice of assessment of your previous financial year. So for single people who are earning more than $100,000, unless you're a single parent, or for couples that are earning more than $160,000, you're not eligible to use this scheme. I have an issue with that because I just wonder if that income band is right. And maybe this is great because it really is servicing that part of the market where from an income band perspective, they are unlikely to be able to get in without this sort of support. But I also think, $160,000 for a couple, if you've got a couple of kids, that's not a huge amount of money. Maybe I just live in a privileged bubble. Anyway, important, because if you thought you were eligible and you are earning over that, unless you're a single parent, you earning that over that 100,000 or 160, you're not eligible as far as I can see. You must live in the home as your primary place of residence or your principal place of residence whilst you're part of the scheme. So you can't make this an investment property. They're not eligible. You can't own property in Australia already. You need to be an Australian citizen. There are exemptions for single parents who own property jointly with someone else and they want to buy out the other party's shared interest or intend on selling their existing ownership. So presumably, if you own a property with your ex-partner and either you're in the process of buying them out or selling out of that existing property, it does look like there's an exemption to make that possible. You can purchase a vacant block of land for the construction of a new home or a property that's being demolished and rebuilt, provided you've signed a comprehensive building contract with an eligible builder. Basically, there's a whole bunch of criteria that you need to go and look at, and you do need to apply. So remember that there's only 10,000 places a year. And yeah, you're going to need to obviously make sure that you have been accepted, and you need to put that application in. There's participating lenders that you'll need to go through. And so what I would say to you is if this is something that could potentially put property on the table for you, that perhaps was, I don't know, not near the table any time before this, go and read all of the info because there's quite a lot of hyperlinks on this resource page, firsthomebuyers.gov.au. /Australian government help to buy scheme. This is not sponsored by the government, by the way. But I just would want you to make sure you understand absolutely everything before you decide whether this is a great thing or whether this is something that you are, in fact, ineligible to use. Because I would hate for you to not know all of the deets and then find out later, shit, I could have used this and I didn't. Or go through the whole process only to be told, no, mate, you are not eligible. Nice try. Thanks for wasting all of our time. So what do I think about this? I think this is good. I think it's good. I think it's a good start, right? I think what the government has realised is we can't rock the boat too much with house prices because otherwise we're going to do some big swings in a massive market and no one wants that. That's not great for politicians' support, sure. But people can't borrow the amount of money that they need to be able to buy a property. What are we going to do here? Well, if we take a chunk of the ownership and you own it technically, but we, bankroll a portion of it, then that sort of creates more capacity, it creates some more affordability, et cetera, et cetera. Obviously, my issue is that income band, again, we saw that taken off from the 5% deposit scheme, but here we've got, I would say, quite low income bands. So it's interesting to see in one respect, they're kind of taking away some of the things that they had in place. And I think going too far. And then on the other hand, they've become quite restrictive. I think I would like to see that income band move up because for a lot of people who are earning more than 100,000 and renting, etc., it has made it quite hard for them to save anything. And you can have your own opinion on that. Sure. Come at me, Jess Brady _financial advice on the gram. So yeah, I'd love your thoughts. Would you use it? I've already had a friend say that she wanted to use it. Does this make property more attainable, appealing, affordable, all the things? Let me know your thoughts. If you're one of those 10,000 and you've already been approved, well done you, because it's been legitimately one business day. This has been open for since at time of recording. But I would love to hear from you all. I know in places like the UK, they do rent to buy schemes. Are we going to see more of that option? Well, those sort of options, I don't know. At a fundamental level, it pisses me off that we need schemes like this because obviously the government's realised, yeah, we're going to have a lot of people who are locked out of property for a really long time. And we could be doing other things to perhaps cool down the market. That has cascading implications. And I just don't know if there is a perfect solution. So maybe this is the most perfect that we got for now. Anyway, let's move right along and stay still on the property stuff. I know there's other things that are coming, but I just want you to have a bit more of an understanding of this 5% deposit scheme because allegedly there's quite a backlog, which I'm definitely not surprised at, but let's just give you a bit of a hot take on where we're at with this 5% deposit scheme. So, as you might recall, the government had already had this scheme in place, right? But they were making some changes to it that was going to start in January 2026. Seemingly weirdly, overnight, a few months ago, they were like, nah, we're starting it on Monday. We were all like, sorry? Anyway, they did start it on Monday. And there was a bit of a scramble. I don't think we've yet seen the fallout of what this has done to property prices. I did an episode on that a couple of weeks ago. But new reports show that this first home guarantee, that's the 5% deposit scheme, right? Where the banks don't charge you lender's mortgage insurance or LMI because the government is basically backing you. It's kind of blown out. Like, this has become a really big amount of admin. Thoughts and prayers to mortgage brokers everywhere and banks and all of the people who work in any of those affiliated roles. Not laughing. I feel like it would be very stressful because allegedly the processing times have massively blown out, and so have pre-approval wait times or time frames. I guess this is because so many people are now like, oh shit, I thought this was coming in 2026. I need to get my ducks in a row. Everyone's trying to row their ducks, get their ducks lined up. And that has just massively, crunched the system. You put too many people in the machine and the cogs start going slower and slower. So what we have seen allegedly is that banks have been absolutely flooded with the amount of apps or applications that they're getting. And it is meaning for first home buyers watching this market that they thought that they couldn't get in. Like, what an emotional BS roller coaster, right? You're like, shit, I'm watching the market go up. I'm not able to use a 5% deposit scheme. Albo et al. Come along with their fairy wand and go, ching, we've changed it so now you can be part of it. You're like, oh my God, this is amazing. You like getting your head in the game going, holy shit, like, am I going to do this? Is this going to happen? You bravely front up to, I don't know, the bank or the broker or whoever, and you're like, right, I need pre-approval. As you're like getting excited and starting to look at different properties online and I don't know, all the things. And then suddenly you're like, shit, why is this taking so long? I'm missing out on all these properties. I now have my head in the game and I can't participate. I'm on the sidelines still. How did I get back here? I reckon that would be quite an emotional mindfuck, if I'm honest. And so if you are in the midst of this, yes, there are big backlogs. If you are thinking about getting a pre-approval, I want you to really factor that time frame in and just like have an honest conversation with a broker. Do you have capacity? What are the current turnaround times? Like, how long will it take to get a pre-approval at the moment? Especially in the lead up to Christmas. Like, normally stuff sort of falls off a cliff December and then doesn't kind of come back until sort of mid-Jan. So again, you don't want to get your hopes and dreams, I don't know, to go to that auction next weekend and think you might be able to bid when you don't even have pre-approval in place. Please, God, do not do that. So let's get you a bit organised in case you are wanting to buy and we need to factor in these pre-approval blowouts. Firstly, get a broker and like go and talk to Rach and the team from Sphere if you need to. I'm sure there'll be links in the show notes, or go and talk to the broker of your choosing. Basically, you want to actually understand, where are you at? What are you looking for? What capacity do they have? And frankly, if you need to move quickly, you want to know which lenders currently have the best turnaround times and the best products. We can't just pick the best turnaround times unless it's like emergency, and let's hope it's not emergency. But like whether it's worth waiting to get a better product, having that conversation with a broker is really important. And if it does mean that you wait but you get a better product, obviously you need to factor in what you think the market will do and property, the diabolical property world. Between now and then, keep your spending squeaky clean, my friends, because this is a spendy time of year. And remember, the banks are going to look at that. So you've got to get all your documents together. You know, I don't know, but there have definitely been situations where lenders are like looking through statements more closely, looking at, you know, querying things that perhaps they may not have in the past. Whether they're doing that when processing times are being blown out, whom's to say? But just make sure you've got all your stuff ready. The last thing that you want is your broker then chasing you for, I don't know, your ID or up-to-date bank statements or some bullshit thing that you really could have honestly had ready for them. Because if you're ready to go, you've got to actually be ready to go and have all of your stuff ready to go. I say this as someone who has not always done this properly. Learn from my mistakes, my friends. And yeah, just make sure that you are being considered in terms of like understanding your budget, and if they can lend you X amount, is that actually how much you want to take? Like, can you afford that, really. Not aspirationally where you never buy clothes again, never go on a holiday, the dog never goes to the vet or the cat never goes to the vet. Like, how much is this going to impact your life? Because it can be easy to just say yes and then hope that it'll all figure itself out later. And then when later comes, it can be quite stressful to realize I have to throw all my other financial goals into the bin because I legitimately cannot afford anything other than to pay my mortgage and stay alive. That's not a fun experience for many people. Let's get on the front foot and make sure you're borrowing an amount that is right for you and is manageable, especially if we have interest rate changes, which I'm going to talk about a bit later in this episode. And of course, I wouldn't be rushing out to be getting, new car loans, new credit cards, I don't know, any sort of new debt during this period as well. Again, talk to your broker about what that might mean, but it might impact your serviceability and how much from a borrowing capacity you can take on. All right, that's it from a property first home buyer lens. After the break, I'm coming back to tell you about what the hell's going on with APRA making some changes to borrowing, I think a lot for investors, but I'm going to bring myself up to speed along with you because some things have changed over the last couple of weeks. And I want to give you some hot takes on interest rate changes and some other things that are coming up or have changed recently that I think you need to know about that impact your money world.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to moneypodcast.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia so they can connect with you wherever you are. That's moneypodcast.com.au and click Get Help.
Okay, welcome back. Property is featuring heavily lately on the podcast, and it's not for any other reason that there's just been a lot of changes and a lot of stuff happening. But don't worry, I've got some EPs planned that are going to give you more info on things other than property, because there's lots of ways you can invest your money. Property is one of them, a common one, but only one of them. Let's talk about, though, this recent change from APRA, which is a regulator, in terms of high-risk borrowing and what they're kind of cracking down on. So this came out a couple of weeks ago, but effectively APRA has stepped in and they are making changes or have made changes to curb high debt-to-income lending. So basically looking at loans where someone was borrowing more than 6 times their income. And I don't know how many people were borrowing that amount, but clearly enough for APRA to be worried. Why have they done this? Well, I think that that's obviously when there's volatility in interest rates or economic, conditions more broadly. It's probably where people get in a bit of trouble because they're borrowed up to their eyebrows. I said eyebrows once and then I've just decided it sticks because it's right at the top there. So allegedly, who is this going to impact the most? Apparently it's going to be investors, property investors, especially if you are an investor and you were really hoping to leverage the bejesus out of the equity that you have in a property, say to borrow to buy another one. So, a lot of property experts would sort of tout this strategy and, you get huge growth from an investment property, then you borrow against the growth on that and buy your next and kind of rinse and repeat, and Bob's your uncle, you're a bazillionaire. I think APRA's no, not if you're borrowing more than 6 times your income. So again, if this impacts you or is likely to impact what you've been planning on doing, definitely go and reach out and speak to your broker to see hey, do I need to completely pivot my plan here? Does this impact me? What do I need to know or understand? It might also impact you if you are, say, upgrading. So maybe you've got an existing property and you're wanting to kind of retain that property but do an upgrade. You might find that the lender isn't going to lend you as much or be as flexible as perhaps they could or would have been in the past. And this is obviously a bit of an issue for a fair amount of people because property prices have grown exponentially compared to wage price increases. So if you look at house price growth versus wage price increases, there is a big issue, and that is sort of what has frustrated people for so long. And so again, whether banks were actually lending you, I don't know, were banks even lending 7, 8, 9, 10 times income. That seems exorbitant to me, just in terms of how much interest you would have to pay, let alone the principal. But again, if they were, you might find you're in a bit of trouble now, especially if you're in a market that's quite expensive and that was your whole game plan. Like, I don't know, Sydney. But even, I mean, I say Sydney, but like just everywhere, really. I think first home buyers with good incomes are less likely to be impacted. Again, depends on how much you're buying for versus your income. Obviously, if you are borrowing well below that 6 times, I don't think you're impacted. And people with low debt, thanks for joining along, but like I don't think you're impacted so much. But I think for a lot of people who maybe decided rent vesting and had been sort of watching people use that strategy and build their empire, they're probably a bit nervous. And like maybe rightly so. All right, let's change tack a tiny bit. We're pivoting a slight amount, but not fully, because the economists, our friends, with their crystal balls, honestly, their crystal balls are murky on the best of days. You might recall that many of them said that there would be an interest rate reduction, probs, at the end of 2025. I mean, here we are. No interest rate reduction. And then they said, or perhaps 2026, early 2026, and or early 2026. So many of them have been kind of reviewing and reforecasting with their crystal ball. I'd love, low-key, to see an RBA economic prediction meeting. Like I'm imagining, and I'm so sorry to any economists that are listening, hello and welcome. I'm imagining that they've got some sort of giant crystal ball that they have sort of in a box, like quite a, contained box, almost, like the golden snitch, whatever it's called, by she who shall not be named. We can't talk about her, but you know who I'm talking about. And then it gets unveiled in this meeting, only with very important people, and they like take the velour off, and it's fancy and it like glows, and then they put their hands on it. I know I'm going on a crazy side quest, but like stick with me. And that is how they decide, based on the vibes that they get from touching. If you've ever been to like Questacon, when you put your hands on those things and then all those electricity lights light up. Who on earth knows what I'm talking about? I'm only halfway through my first coffee of the day. Is it apparent? I reckon it is. Anyway, I reckon that's how they make predictions, because many of them, the vibe that they give us, that we all make decisions from, changes. So what say thee for 2026? My friends, they've had quite a change of pace. So many of the majors are actually like just quietly scribbling out what they'd forecast for 2026 and writing the exact opposite and saying that perhaps instead of those reductions, it could be that early 2026 has some rate rises. I know that that's not what you want to hear. Please do not attack the messenger. I am but the messenger. Again, let's hope that they've got their crystal balls wrong. But if we kind of step back and think, why would they say one thing and then move to the next? This is the problem when you have economists who are trying to literally guess what the wind is doing in the next 6 months. I mean, how do they know? They have to use the data that they have at the moment that they're making that call. But what we have seen recently is that inflation is still too sticky. So, the recent inflation data was slightly worrying when I saw it. I think it was something like 3.1%. Again, I've been away, so it could have changed again since. But, the RBA wants it to be within that 2 to 3% band. I would say they've been pretty cautious, though. They haven't been kind of as rash or haphazard to like make massive changes quite quickly. Bullock and her team seem to be quite measured and cautious, and just kind of very wait and see, which I quite like off the back of what we had before that. However, if we look at what's going on sort of globally, that probably is giving them a little bit of the heebie-jeebies as well. And interestingly, allegedly, fixed rates sort of tend to move in line with what they think the market will do, irrespective sort of where the cash rate is right now. They're trying to make a prediction based on where they think the cash rate is heading. And apparently Westpac and Macquarie Bank are among many lenders that have already increased their fixed home loan rates since the 1st of November. So that is interesting. Is that the canary in the coal mine? I don't know, because I need to have my own crystal ball. If someone could please send one to me, let me know. But what does this actually mean? Like, do we need to care? Yes and no. Yes, we need to care because it could impact our budget, but we cannot live in this state where we're constantly, living and dying by whether, on the first Tuesday of said months, some months, our lives are diabolically going to change or not. We need to preempt that they may change and be ready for that. And so, if they do go up, of course, if you've got a variable loan, it is likely that you're going to have a higher mortgage rate. I would love for a bank just to be like, you know what? We're not doing it this month. We've changed our mind. Will they ever, I don't know. We've just done Black Friday. And I feel like that would be one that I could get behind, where a bank's just like, we didn't do Black Friday, but actually we know that the RBA lifted rates. We're not going to for you. I reckon that would just be, that would generate a lot of interest. Anyway, if you work for a bank, you're welcome. That's a marketing idea for you. It might, beyond obviously costing you more month to month, but it might it's likely to reduce your borrowing capacity, because obviously if you're spending more on your mortgage, you're not probably able to borrow as much because your budget can only stretch so far. And if you've had a fixed loan, can I just say a special hello to those people who were on 5-year fixed loans that were 1.99 that have recently come off, and they're like, oh shit, welcome to 5 point something. Yeah, welcome, my friends. If you are on a fixed rate loan that is a pretty good rate and you're rolling off that, be ready. Make sure your cash flow is ready. So I do not like this crystal balling, especially when we're talking about really far away. I think it is creating, it sells stories. It creates media hype. People love speculating. Sure. But you've got just as much chance of guessing correctly, I think, as, I don't know, you do. I was going to say betting on the horses, but no one really does that anymore, do they? All you can do is be ready so that you are not going to get whiplash or giant shock or having to sell an asset because you can't afford it if it does happen. Between now and then, anything could happen in the world. And so you just need to be prepared and ready, because we don't want to have knee-jerk reactions with our money. We want to be, clear and considered, and we want to hope for the best, but financially prepare that things may not go exactly our way all the time as well. Okay, a couple of other things to round out today's What in the World? What in the world? Honestly, what in the world? 2025 has totally been a what in the world kind of year. Am I right? Some good news, hey? Let's give you some good news. We have something in the money world called LISTO, just because we love acronyms to confuse the bejesus out of you, which is the low income superannuation tax offset. Yeah. From July in 2027, which I realize is a little bit away, but I just want you to know that this has recently changed. They've increased the threshold, or they will be increasing the threshold. So currently, if you earn 37,000, I think it is, you're entitled to, I think it's 500. But that's moving from 37,000 to 45,000 as the income bracket, and the maximum payment is going to increase. I think it was from 500 up to 810, which is good news. Now, this hasn't been passed yet, but I think it is a really big deal if you are boosting your retirement savings, especially if you're on a low income. So if you put in a certain amount of money, you get a tax offset, and that is increasing in terms of the annual income. So more people will be eligible, but also the payment is going to increase as well, which is great. Also, in terms of market stuff that's going on, we normally see, the markets are a little bit grinchy, which isn't that just the way to end 2025? Yeah. Normally in December, we get something colloquially called a Santa rally. Or maybe they call it Santa Claus rally. I can't actually remember. Basically a rise to Christmas, and then everyone just goes on their, ski trips or trips to the Bahamas, or wherever everyone in finance is tottling off to. But this year, analysts are saying, no, that rally may not actually show up. because of the sentiment that is happening globally, and apparently, investors are a little bit more cautious at the moment. And again, it's kind of really interesting when you see analysis like this, and even me having a conversation about this, because then it becomes really chicken and egg. Like, are they cautious because they're actually cautious, or are they cautious because they hear people talking about people being cautious, so then they decide to be cautious, so then everyone starts being cautious? Can you see the circle that it can then kind of create? So if you're an investor, what should you do? Firstly, don't panic. Like everything, whether Santa arrives or the Grinch arrives for December, and whether markets rally or they don't rally, or whether they, we have what's called a bear market, where markets go down for a period, we should kind of not be bothered nor deterred if we are doing long-term investing stuff, which hopefully that is why you're investing. We don't want short-term stuff to derail our long-term plan, and especially, when there is media hype, it can be really easy to kind of get sucked in, especially if you're on holidays and you're reading a lot more news than maybe you normally are, or, you've got more time to engage in this sort of stuff. You might find yourself being swept or more tempted to make a decision that is not in line with your long-term plan. I would strongly encourage you to go back to your long-term investment strategy. I teach in the greenhouse, prepare for the bear sort of situation. And so if you've done my program, go back and look at your sleep at night answers and have your accountability buddy on the ready should you need them. I would say, especially over this period, if you're planning on making any decisions because you're worried about markets more broadly, or perhaps because you just spent a lot of money and you're like, I bought gifts and had a great old time, but now I can't afford to continue to put money into my investment plans, I'd say thank you, but no thank you. That's not how we prioritize our cash. Said with so much love. If you can, keep on keeping on would be my general stance. Keep dollar cost averaging. That is why dollar cost averaging as a concept works, whether it's a red day or a green day or whatever. We buy at regular intervals and we smooth out that buy cost over time, and we are consistent. Remembering some of the best days in investment markets have come pretty quickly after, what we would consider poor performing, or really some of the worst performing days on investment markets. If you're finding yourself wanting to make an emotional decision about an investment market, buy, sell, hold position, just take a little pause and ask yourself, what are you investing for? What is the goal? Again, not having a goal is where you can come really undone here, but where you've got a really strong goal gives you so much more conviction. Cool, I'm trying to retire by the time I'm 55. Or go to part-time, or I'm hoping to get this amount of passive income, or I'm doing, the rule of 25 and I'm currently at this point. Great. Then do I really want to stop? And what would stopping mean for me? If I sold, what would that actually do for my goal? And is that the right thing to do? Obviously, only you can make that decision. But I think it is a really, really important one. Think about in 5 years, in 10 years, is this time going to matter? It might, but it might not either. I'll be very interested to see if that Santa rally occurs at the end of 2025, or if we're just having a grinchy old time. I think I'm assuming it's going to be the Grinch. You can probably tell I'm just a bit grumpy at the moment. I think I've been grumpy a lot of 2025. So why stop now? I reckon the Grinch is here for 2025, but again, no crystal ball. I could definitely be wrong. Turning to other news, this is a really fantastic change, and it's called Baby Priya's Law. And I probably should do a trigger warning because this has got some heavy child loss topic or themes to it. So skip forward a couple of minutes if that is something you need to do. But I want you to know that from early November of this year, the government made some changes that basically has said that employer-funded paid parental leave can't be cancelled if a child is a stillborn or passes away, unless both parties apparently explicitly agreed otherwise. I'm not sure who would agree to that, so I'm assuming that that's no one. And this also aligns with employer-funded leave and government-funded leave and unpaid leave. This law was named in honour of baby Priya, who apparently passed away at just 6 weeks old, and I think is a really important step to make sure that from a legal standpoint, it is giving parents the right to have paid leave at a time that is probably one of the worst in their life, and to be told, there is a part of me that's like, why do we even need this as a law? But obviously the fact that we do need this, or it has been passed, tells me that we do need this as a law. Like, you'd like to just think that most people in business land would do the right thing, but this screams to me that perhaps that is not the case. And no one at a time like this should be fighting for the right to continue to have paid parental leave when they are physically in need of recovery and emotionally coming to grips with the situation that has no doubt been different to perhaps what they expected. Like, I sometimes think, okay, we live in a nanny state and we have to we've over-regulated and over-engineered everything. And then I remember that sometimes if they don't pass laws that are doing the right thing, people don't always do the right thing, which is shit. But I'm really happy to hear that this has gone through, and I think that we should absolutely be supporting everyone at this time. And this affects a lot of families actually. And so, obviously this is really tragic, but baby Priya has created a legacy that is going to help a lot of people in their time of need. So I think that that's really, really nice. So obviously this is going to, mean that if this ever happens to you or someone that you love, there is a lot of certainty, not a lot of ambiguity around oh my God, does this mean that this gets cancelled? I think it gives people, some financial stability and security during that time. No one wants to have to be forced back into work at that sort of time because their leave gets cancelled or not paid, etc. So I think that is a wonderful, wonderful change. And it's one that obviously you just hope that you never need, or that no one you ever have even met needs. But very sadly, it is something that people will use, and I'm sending anyone that has been impacted by that all of my love, all of it, and then some. Okay, so the world is... the world is just a lot at the moment. And I think this is probably going to be my last my first and last What in the World episodes, which I think I need to kind of bring in with probably more fiery hot takes in 2026. What do you think? If the answer is yes, just let me know. Jess Brady _ financial advice. I think we should do them more often, but I think I should come with more rants ready. Sometimes I just think, wow, just when you think the world can't get weirder, I am constantly gobsmacked. But then I look at history because I'm quite a history nerd, and I'm like, yeah, okay, the world has always been a really weird place, and perhaps it's just that we have so much access to information, albeit I do think that this year particularly has been a lot. In saying that, there's been some great stuff. I know that I'm in a grumpy mood, and you're welcome to be part of that movement along with me, but I think we also need to step back and go, you know what, some of these moves have taken at least a step in the right direction. They may not be perfect, they may not be excellent, they may not be as good as they could be, but they are a stepping stone to, what I hope to be more progressive laws to help more people be financially secure and stable, because I'm very worried that if we don't have more of these, the middle belt of Australia is going to be washed away, which is a big, scary thing to say, but I genuinely am worried about that, looking at all the data, which is why I'm so glad you're here. I'm so glad that you're engaging with money stuff and getting on the front foot and being like, absolutely hell no, is this going to be my outcome? And I'm going to do everything that I can within my power to plan and to change course and tactically, move with the winds, because we can have a plan, but if the weather changes, we need to adapt and we need to take the route that is going to get us there safest and most appropriately, and perhaps the fastest, depending on what's a priority for you. I'd love for you to just tell me, what has changed in maybe the broader landscape that has impacted you the most in 2025. There's been regulatory stuff that's been good for you, bad for you. Where are you at? I just had a lovely friend who, and shout out to her because I'm so bloody proud of you, bought her first property as a single mum 2 weeks ago, I think. And, you know, there was a time when she was absolutely convinced that that perhaps wasn't going to happen. She made some really big changes to make that happen in her life. And I just want to share that, A, to celebrate the bejesus out of her, but B, maybe give you some hope. That is all from me for today. If you've got anything that you want me to cover in a long ranty episode, I've got a whole list of them, but if you want me to add to that, you do that. Jess Brady _financial advice on the gram. Otherwise, chuck it in the money Facebook community. That is all from me. Thank you for being here. We can be grumpy together. You know what to do. You know what to do. Go now and be financially fierce. Bye.
We acknowledge the traditional owners of country throughout Australia. We pay our respects to elders past and present. Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Jessica Brady is an authorised representative of Paragem Pty Ltd, authorised representative number 1259972, AFSL 297276, ABN 16108571875, corporate authorised representative number 1305567.